Whole life insurance was sold to you as the financial equivalent of a Swiss Army knife, steady, reliable, and basically magical. But what happens when the magic starts to look more like a slow leak? Let's talk about dividends first, because this is where most people get genuinely confused. When your whole life insurer declares a dividend, they are essentially returning a portion of overpaid premiums back to you based on how well the company performed that year across mortality, expenses, and investment returns. The key word there is declared, because dividends on whole life policies are not guaranteed. They are a projection, a best guess dressed up in a suit. Think of it like a restaurant promising you a complimentary dessert based on how busy they expect to be, and then reserving the right to cancel it if the kitchen has a rough night. Now here is where the interest credited to your cash value enters the picture, and this part matters enormously. Insurers credit interest to your cash value through a combination of the guaranteed base rate baked into your policy and the non-guaranteed dividend component layered on top of it. The guaranteed rate is typically somewhere between 2 and 4%, and that floor will not disappear on you, but it is also not going to make you feel rich. The dividend, however, can meaningfully boost your effective cash value growth rate, sometimes pushing your total crediting rate into the 5 to 6% range in optimistic, illustrated scenarios. Here is the uncomfortable truth that agents sometimes gloss over during the sales presentation. Those illustrated rates you saw in the pretty ledger were built on current dividend assumptions that could change, and in many cases historically have changed, sometimes dramatically downward over multi-decade periods. In fact, many major whole life carriers have steadily reduced their dividend scales since the 1980s, when crediting rates were riding the coattails of sky-high bond yields. A policy illustrated at 7 or 8% in 1985 may have delivered something closer to 5% through 2005, and that gap compounds into a very different retirement picture than what the brochure promised. So, what actually happens to your cash value if dividends shrink or vanish? Your policy does not collapse, but the growth trajectory flattens like a tire with a slow puncture. The guaranteed column in your illustration, that boring, worst-case scenario page most people skip, becomes your new reality. And suddenly your projected paid-up additions, your loan capacity, and your death benefit growth all look considerably less impressive. This is the scenario where people start calling their agent confused and frustrated, wondering why the policy feels like it is underperforming. A conservative illustration assumes dividends stay at a reduced rate or are stress-tested against declining scales, while an optimistic illustration assumes the current dividend scale holds or even improves indefinitely. One of those assumptions has a perfect track record of being wrong across every economic cycle we have ever lived through. The actionable lesson here is simple. If you own a whole life policy or are considering one, demand to see both the guaranteed column and a midpoint illustration, not just the current scale. Never size your financial plan around the optimistic column, because you are essentially building a budget on the assumption that your restaurant always gets a 5-star Yelp night. Think of your whole life policy like a very conservative bond in your portfolio. It has a role, it has value, but pretending it is a growth engine without scrutinizing the assumptions is how smart people end up disappointed. Discipline means reviewing your in-force illustration every few years, adjusting expectations, and never over-leveraging against projected cash values that depend on non-guaranteed dividends. At the end of the day, whole life insurance can still be a legitimate tool for specific goals like estate planning, guaranteed death benefit, and tax-advantaged cash accumulation, but only if you walk in with clear eyes and realistic numbers. The philosophy is the same as it always is in financial planning. Hope for the optimistic column, plan for the guaranteed one, and sleep better knowing you built your strategy on the conservative floor. And honestly, whether dividends hold steady or drift lower over the next 20 years, the people who thrive are the ones who understood the product fully before they signed. If you are ready to take that kind of clear-eyed approach to building real wealth, whether through whole life strategies, real estate investing, home contracting projects, or connecting with the right lenders, check out our links in the description below and let us help you get started.